Welcome back to the channel. In today's video, we are taking a quick and simple look at fundamental analysis. No complicated jargon, no advanced theories, just the basics you need to get started. This is a beginner-friendly guide to help you understand how real-world news and economic events can affect the markets. If you enjoy clear and simple trading content, make sure to hit like, leave us a comment, and subscribe to stay updated. Let's get right into it.
Fundamental analysis is a study to try and identify the real and fair value of an asset, what is known as intrinsic value. Not the speculative value, but the real value. The theory is, if an asset is undervalued, then potentially in the future that could present a buying opportunity. If an asset is overvalued, then that means it could present a potential selling opportunity. In this segment, we will go through the several areas of fundamental analysis you'll need to be aware of when you're looking to trade currencies, commodities, and stocks. So let's get real. When it comes to currencies, there's always one question. What makes one currency more valuable than the other? Both are made from similar paper. Both are the same size. But why is one valued higher against the other one? Now the theory goes, the stronger a country's economy, the stronger potentially is their currency. Now there are several ways that you can measure a country's economic strength and potential future strength, and this is by monitoring economic indicators which are released to the world on a regular basis. You can find these indicators on any economic calendar. Some of the key indicators to be aware of include the following. The non-farm payroll. Now this is released usually on the first Friday of every month, and this is key job growth data for the United States. If the number comes in high or higher than expected, it illustrates the US economy is growing, which potentially could mean the US dollar may gain strength against the likes of the euro, the Great British pound, the Swiss franc, and Japanese yen, etc. Retail sales. The modern day world economy is driven by us spending our money. This data is released from a number of different countries, and the theory is, if retail sales are growing, it means we're spending our money. The consumers are confident and there is more capital going into the economy, which potentially means the economy is growing, which could impact the value of that country's currency. Unemployment rate. Unemployment rate measures the percentage of individuals unemployed in that country. If the percentage is increasing, it means more and more people are out of work, which means there is less money going into the system, and it creates greater costs such as unemployment benefit for that country in question, impacting that country's economy and potentially the value of that country's currency. GDP, or gross domestic product. Now this measures the overall health of a country's economy. If the percentage is increasing, then happy days. The country economy is growing, and this could increase the currency's value. However, if it's decreasing, not good, and that could indicate the country is struggling, and so could its currency. CPI, Consumer Price Index. This measures the value of a basket of goods. In other words, inflation. If inflation is rising, it means it's getting more expensive for us consumers to purchase items, which means there'll be less money going into the economy. If inflation is decreasing, it means goods are cheaper and we can spend more. If that's the case, good times for the economy and potentially for the currency. Interest rate decisions. Now, central banks tend to do two things, and this is known as tightening or loosening. When the economy is booming, or if inflation is high, a central bank will look at increasing interest rates. This is known as tightening. They do this as they feel the economy is performing and to encourage us to start saving our money due to the higher interest rates. If the economy is under pressure and struggling, the central bank will look at decreasing interest rates. This is called loosening. They do this to try and encourage us to borrow and to spend our capital to inject life into the economy. The higher the interest rate can potentially add strength to that country's currency as the outlook is looking good. It can also encourage more international investment into that country. Lowering interest rates is not a good sign and can potentially damage that country's currency. Finally, press conferences. All major central banks hold on a regular basis press conferences where they can hint at what they may do in the future. There are two key words to look out for which describe the tone of these press conferences: hawkish and dovish. If the press conference is described as hawkish, it means the tone was aggressive and indicated potential interest rate hikes in the future, which could strengthen the currency in question. If the press conference is described as dovish, it means the tone was nervous and cautious, which shows signs that the central bank may expect to reduce interest rates in the future. This can impact the currency in question in a negative way. So these are some of the key indicators to use when you're using fundamental analysis to trade currencies. When it comes to looking at fundamental analysis for commodities, there's two important words to take into account: supply and demand. Those two simple words are vital. Firstly, let's go over the different commodity groups. Soft commodities. This includes the likes of cotton, coffee beans, cocoa beans, wheat, soya beans. Then you have metals, which includes gold, silver, copper, and platinum, etc. And finally, you have energies, which includes the likes of WTI oil, Brent oil, and gas. These commodities drive the world. Let's look at soft commodities first. These are agricultural produce. So firstly, we need to be aware of weather conditions. Has it been a good harvest, which could affect supply? We can find out such information from the US Department of Agriculture. You also need to take into account what countries produce such crops. Let's look at coffee beans. Countries which grow coffee beans includes the likes of Brazil, Vietnam, Colombia, Indonesia. What is occurring with those countries? Is there civil unrest, for example? Then look at demand. Is there an increase for such a need for such produce? Moving on to metals. The question you have to ask yourself is, what is that metal used for, and what is its main purpose, and is there a demand for it? Now, there tends to be two major uses for metals. Firstly, let's look at gold. which is though is used in some manufacturing, its main attraction for investors is as a safe haven. What is a safe haven? Well, at times of uncertainty, conflict, recession, smart money moves into safe havens. This is called the flight to safety. Safe havens include the likes of US dollar, Japanese yen, Swiss franc, and gold. As well as that, gold is heavily linked to the US dollar, so any key US economic information or data can also affect gold prices. Don't forget to check out your financial calendar. So, rounding it up for gold, when times are looking bleak, gold tends to shine. One of the other purposes of metals is industrial use. Copper, for example, is a metal used in all different types of manufacturing. So when there's economic growth, copper, also known as the red metal, could possibly rise in value. Supply of such metals needs to also be taken into account. What countries produce metals, and is there a danger of that supply chain being affected? And finally, energies. Oil and gas currently drives the world and is needed for almost all our current needs, from transportation, heating to industry, and even household products like lipstick. What countries produce oil and gas, and what is happening to those countries which can affect supply? The Middle East is a major source of oil, and at times of conflict or risk of conflict in that region, oil prices can be greatly affected. Russia, for example, is a major supplier of gas. At the time of the Ukraine conflict, sanctions was placed upon Russia, which affected supply and in turn affected the price of gas. Another key thing you need to be aware of when it comes to supply of oil is OPEC. OPEC is the Organization of Petroleum Producing Countries, and this organization has the power to increase or decrease oil production, which can greatly affect the price, not only what we pay at the pump, but also the market price. And finally, demand. As mentioned, oil and gas is used in so many things such as industry. Is there industrial or economic growth, or is there a slowdown? When times are good, demand will also be good. However, when things are not looking too good, demand and price for oil and gas will also not be so desirable. So remember, when it comes to fundamental analysis for commodities, it's always about supply and demand. When you're looking at fundamental analysis for stocks and shares, there are many aspects you need to take into account. One such thing is growth. If you're looking at trading Microsoft, for example, how is Microsoft as a company performing? Is the company growing, or is there trouble ahead? One of the major ways of looking at how a company is performing is earnings season. Earnings season occurs every quarter, and this is when all the major corporations like Microsoft, Apple, Google, Facebook, Exxon, JP Morgan, for example, release their quarterly earnings, which reveals how they have been performing financially and future prospects. Have they performed to expectations, or have they fared a lot worse? This can greatly affect their stock value. Then ask yourself, what does that company do? For example, Apple produces electronic equipment such as mobile phones. How is the mobile phone market doing? Is demand high for such luxury items, or are there signs that the desire for such items are declining? And is there economic concerns where consumers can afford to purchase that luxury product? You also need to take into account competitors and how they are performing. If you're looking to trade Facebook, for example, whose major revenue comes from online advertising. If a similar company like Snapchat has a fall in revenue, what does that mean for Facebook? Also ask yourself, who are the people running the company? A company is only as good as those leading the way, and this can also affect a company's share price. And finally, be on the lookout for buyout rumors. That is a key area to be aware of. For example, for those football fans out there, when there was rumors that the owners of Manchester United was considering selling their share of the company, Manchester United's share price on the New York Stock Exchange skyrocketed. So always be aware of any market noise.